Airbnb IPO analysis, StockerFinance. I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more information, or patreon.com/StockerFinance to support the show. Now, we're going to be looking at the Security and Exchange Commission's Form S-1 registration statement for Airbnb Inc. It's going to be IPOing very soon. This is the form that basically is a sales pitch. If you've never read one of these forms, it's a sales pitch trying to get investors to invest in the company. And it's also going over all of the risks associated with this company. We're going to be looking at all the details and the knit and grit to do a little bit of an analysis of this company to decide whether it's going to be a potential investment or whether we should maybe stay away from it. Now, they have a proposed maximum aggregate offering price of $1 billion, which is pretty incredible. It's definitely one of the largest ones I've seen in recent times, although we've had a lot of large IPOs recently, especially in the tech industry. And Airbnb is going to be a very amped up IPO. It's a really well-known company. People have been waiting for this one for a very long time. And they're also IPOing during a really interesting time for the company because they're currently suffering a lot from, no one's traveling as much anymore. People are staying home. There's been a lot of things shut down. So they are not operating as the same as they were pre-pandemic. And I'm going to go ahead and just read about their business model here and give some information. And there's a ton of reading. So if you want to get this full form, you can follow along. Just go ahead and look up S1 form Airbnb online. It'll be one of the first things that come up. It should be right with the SEC as well, or on their website. Now let's get reading here. They've experienced rapid growth since their founding sorry about that, stumbled on my words. In 2019, we generated gross booking value of $38 billion, representing growth of 29% from $29.4 billion in 2018, and a revenue of $4.8 billion, representing growth of 32% from $3.7 billion in 2018. During the 9 months ended September 30th, 2020, our business was materially impacted by the global COVID-19 pandemic, with GBV of $18 billion, which is gross booking value, down 39% year over year, and revenue of $2.5 billion, down 32% year over year. So they were really hit hard by the pandemic. Their business suffered immensely, especially because they were growing so much before. They're growing so rapidly, and we'll take a look at that growth in the numbers here in a second. But they really took, and this is going to set them back quite a bit. However, I think this also may be an opportunity for investors to get in on Airbnb when it might be trading lower than what it would be pre-pandemic or post-pandemic once things start to return back to normal. So they generated $1 billion of net cash provided by operating activities and incurred $507 million of purchases of property and equipment cumulatively from January 1st, 2011 through December 31st, 2019, resulting in a cumulative positive free cash flow of $520.1 million during the same period. We believe that we are still early in the global shift and consumer preferences toward one-of-a-kind stays and experiences, which provides an opportunity to further grow our community and business. As a result, we've consistently reinvested the cash flow that we have generated to meet our business needs and expand our operations. During 2019, net cash provided by activities was $222.7 million, and free cash flow was $97.3 million, compared to net cash provided by operating activities of $595.6 million, free cash flow of $504.9 million in 2018. In addition, during 2019, we had a net loss of $674.3 million, an adjusted EBITDA of $253.3 million, which is a loss there, compared to a net loss of $16.9 million and adjusted EBITDA of $170.6 million in 2018 during the 9 months ended. So clearly they're in a bit of trouble. They're not a sustainably profitable company, but they have proven profitability, not in full years. So they haven't been profitable, 4 quarters in a row. But they have had a few quarters here and there where they have been profitable. In fact, I believe they were profitable in the third quarter of either 2019 or 2020, which is a good sign for this company. And let's move on here. So here's their market opportunity. And I just want to go over this little part. It's super short. Usually the market opportunity section is really long on these forms, so I'm glad that they summed it up for us here. They have substantial market opportunity in the growing travel market and experience economy. We estimate our serviceable addressable market today to be $1.5 trillion, including $1.2 trillion for short-term stays and $239 billion for experiences. So they're operating in a massive market. We estimate our total addressable market to be $3.4 trillion, including $1.8 trillion for short-term stays and $210 billion for long-term stays and $1.4 trillion for experiences. We estimated key components of our SAM and TAM using 2019 actual figures, blah, 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 blah. So yeah, they're operating in a huge market. There's lots of opportunity. And one thing I want to point out here is I actually think if Airbnb can make it through the pandemic, which it most likely will, I think they're going to benefit greatly afterwards because this market is so huge, and hotels in places which is, Airbnb's primary competitors are suffering greatly. Lots of hotels are shutting down, forced to do kind of drastic things. Some are taking in homeless people and getting paid by the city in order to bring in revenue. Tons of different events have been shut down, which hotels rely on for revenue and to be profitable. So there's been a lot of hotel closures lately around the world, not just in the US. And I think if Airbnb can come out of this, it might come out on top because people will say, okay, there's no more hotels, or the ones that are operating need to make up for the loss. So they're trying to charge a lot for rooms. Whereas Airbnb, how if you've never used Airbnb, basically it's someone else, an individual or a family who's just renting out their home or rental property, etc. Or some people have properties that they only use for Airbnb. And although it's hurting right now, they may come out on top because of all the hotel closures after this, which means less competition for Airbnb, which means Airbnb can take more market share from this massive market opportunity. Now let's move on here. I'm only going to read one section of the long-term growth strategy here because a lot of it's just kind of wishy-washy wording, like invest in our brand, unlock more hosting, engage with our community, etc., etc. It's basically the same thing on every S1 form of these tech companies. But here's one that I thought was kind of interesting about how they're planning to expand their global network. Now, they expanded their global network in countries in which we already have a deep presence, as well as to expand into markets where our penetration is lower. So this includes India, China, Latin America, Southeast Asia, and tens of thousands of smaller markets and remote areas around the world. I think that's great. That shows that they have more room to expand. They're not fully saturated yet. And they're becoming a large global company, even though they kind of already were, but they're going to continue to grow and become significantly bigger if they can do this correctly. Now let's move on here to the numbers, because this is where it gets real interesting with this company. So far, the prospectus has been, it seems pretty positive. Yeah, they're suffering right now, but after COVID, if they can get through this, they're probably going to come out on top because they're going to have less competition to deal with. They're expanding into new markets, etc. But the numbers definitely show some issues here. And you can tell that when you look at the net loss at the bottom of this page. So in 2017, they incurred a net loss of $70 million. And in 2020, they incurred a net loss of $696.865 million. That's a large net loss, and especially since that net loss has been growing over the years. Now, it actually decreased in 2018 from 2017, then it shot up in 2019, and now 9 months ended, it's shot up again. But also, we have to take into we have to account for the fact that we are in a very unique situation now. We're not in the same situation that we were in 2017 when things were thriving. So will it change once the stuff is over, or will people be more skeptical to travel and their losses may occur more and more? Who knows? That's hard to say right now. It's really hard to predict the future there in the situation that we're in. Revenue, though, had continued to grow from 2017 to 2018. It grew from $2.5 billion in 2017 to $4.8 billion in 2019. So massive growth there. Obviously, we've seen revenue take a huge hit as of 9 months. 9 months ended September 30th in 2020, down to $2.5 billion. But it's not the end of the world for this company. They'll probably do more this year than they did in 2017, which is still a good sign, especially since the economy in 2017 was booming, and now the economy in 2020 is really suffering. And it's not just the economy that's suffering, it's people's daily lives, the ability to go out and stay in new places, the ability to travel, all what impacts this company drastically. If we look at total costs and expenses, it shouldn't be a surprise that we see total costs and expenses increase pretty significantly from 2017 to 2019 as this company continues to grow, spending more on sales and marketing, etc. However, one thing that is a good sign, at least in my opinion, is their their total costs and expenses dropped as of 9 months ended September 30th in 2020. It was $3.8 billion in 2019. 9 months ended, but in 9 months ended 2020, it's only $3 billion. So that's about, almost $1 billion difference there in total costs and expenses during the situation that they're in. So they must have made some cost cuts, etc. And I'm trying to find it here if they made any. It looks like there's a slight cost cut to operations and support. Maybe they laid off some workers. A pretty big one to cost of revenue as well, which is probably the biggest impact. And sales and marketing, it looked like they drastically reduced sales and marketing, which I think is a very good choice for them, because why advertise right now when you know people aren't able to travel? There's no point in spending that sales and marketing. Yeah, you might build up brand recognition, but there's no point in spending, $500 million on sales and marketing. So them cutting their costs there allowed them to actually reduce their total cost and expenses really, significantly to below what it was in 2019 during the same period. period. So that's a great, great strategic movement by this company, and that really proves that the leadership can adapt to different situations here and try to do the best they can in this tough situation. Now let's move on here. I know I've been talking about this a lot. I really want to look at this longer graph that they gave us, which is all the way from 2015. You can really tell that revenue's grown significantly, but you can also tell that the net loss has been, it's increased quite a bit, even to 2019. So it actually was decreasing significantly from 135 million in 2015 to just 16 million in 2018. And then something happened during 2019 where it just shot through the roof, whether they're spending more on marketing, or they made some acquisitions, etc. I'm not sure. I have to look into that, but something definitely happened there. And it's obviously shot up during this time as well. We've already seen adjusted EBITDA. You can tell there were some positive times where they actually had positive adjusted EBITDA, which is great to see. Obviously suffering right now. I know I keep saying obviously, but that's just because it's pretty straightforward for why this company's hurting at the moment. Now let's look at free cash flow here. From 2015, they did negative 123 million in free cash flow. Now they're at negative 520 million as of 9 months ended 2020, but they actually had positive free cash flow all the other years. Now, if we go back in time, or if we go forward in time to where, okay, there's no more COVID, no more pandemic, everything's perfectly normal again, which hopefully it'll get to that point eventually. This means they'll have positive free cash flow, and their free cash flow is also growing, at least 9 months ended in 2019, which is great to see there. So positive cash flow, not horrible. It's expected that it's negative right now. They're losing money. They're having to spend a lot of money on different things to keep their company running. But if things return to normal, they're going to be in a great position, as I stated before. Operations and support, we see those expenses growing. Same with product development. Sales and marketing is declining, which is good, at least right now in 2020, as I already kind of touched on that. General and administrative costs has shot up in 2020 as well, as at least have 9 months ended. And then they also had some restructuring charges during 2020, most likely layoffs or just redoing some things for their company to adjust to the situation they're in. Look at net loss as well. Not a very surprising story there, although we were seeing, we almost got close to a positive net income there in 2018. So it shows that it is possible, and they have been profitable for a couple quarters, I believe 3 quarters actually in total, not in a row, but at different periods in time. And let's move on here to, we kind of already looked at this, so not much to say here, just a longer time frame for free cash flow, adjusted EBITDA, etc. Now let's move on here to look at their consolidated balance sheet. They have about $4.4 billion in cash and cash equivalents. So that's a lot of cash that they're dealing with right now. Total assets about 8.7 billion, total liabilities 6.8 billion. So their assets do outweigh their total liabilities, which is a really great sign. However, they are still at a stockholders deficit right now of 1.3 billion. And if we look at their long-term consolidated balance sheet here, we can tell that stockholders deficit has grown significantly, and actually was growing before as well. So it's 423 million in 2015, all the way up to 517 million in 2018. Then as of 2019, it was 807 million. And as of September 30th, 2020, 1.3 billion. So that deficit is continuing to grow. They really need to reverse that trend. It seems to me, though, that total assets was growing quicker than, in terms of a percentage, as total liabilities. But at the same time, that stockholders deficit is going to hurt them in the long run. They really need to reverse that, and hopefully that'll happen once things start to return to normal, if they do, which I assume they will in the near future. So we're praying for Airbnb for that, at least. They definitely want a vaccine, etc., to come out, because that's going to help this company greatly. And it's really, it's going to depend on this business survival, how long they can hold out right now. But the good thing is they have the cash. They have $4.4 billion in cash right now, so they can definitely hold out for a very long time as of right now. Now, let's go ahead and look at gross nights and experiences booked. That has grown significantly in 2019, which is good. And then we just see the months, which, in 2020, it's going to be very low, especially in the second half of 2020 here. Now, we can also look at gross booking value. It's just a similar story here. And now let's look at nights and experiences booked on a yearly basis, though. This gives us a different perspective, because we can see that it grew significantly from 185.8 million to 326 million in 2019. It dropped in 2020, no surprise. But the fact that it was growing significantly before shows that this company will have, immense growth. And I think people are going to be really eager to travel and get out of the house once things get relatively back to normal. So once things get relatively back to normal, could see a significant increase in nights and experiences booked for this company. Gross booking value, as nights and experiences grow, you're going to see gross booking value grow as well, from 20 million up to 37 million in 2019, and then dropped off in 2020. No surprise there. Now let's move on here. Here's annual gross booking value. We can see it from 2015 to 2019. Immense growth there, which is awesome. Then quarterly gross booking value, different story, but also this is only showing to 2017. Still growing, but just not as rapidly as the yearly chart there. But that's not something to necessarily drastically worry about. Now, annual adjusted EBITDA, we can see really fell in 2019, but 2017, 2018 were positive, which is a good sign. In terms of quarters, they've had a few positive quarters here, which is great. However, it's not sustainable yet, and they really need to make that sustainable in the near future for investors to be more confident in this company. Here's monthly booking trends. It's another graph that they threw on here, which is great to see. We can see that it was growing in the past. If we're going ahead and look at monthly bookings by trends and travel distance, or by travel distance, you can see that here as well. Let's move on to, this is by top cities versus other cities, which is kind of interesting. I really love the amount of information Airbnb gives us. Sometimes these S1 forms, they really don't provide you with a lot of information. They take consolidated to heart and give you as little information as possible when it comes to the data. Airbnb really laid it all out for us. So thank you, Airbnb, for that. As an investor, that's really important because, if we can't understand the company, how they're operating, how the company is doing, then as an investor, I'm going to be really hesitant whether to invest in this company. But Airbnb so far has definitely made me more confident. I just know they're suffering right now, which definitely makes it a risky investment. And for them to IPO right now, that does kind of give me a sign that maybe they're in a desperate situation behind the scenes. But according to the numbers, they're in an okay position, but not an amazing position. And they need to reverse the trend here. They're really hoping that stuff starts to get back to normal, but the second wave of lockdowns is going to continue to hurt Airbnb, and they're just going to have to hold it out right now and continue to take and incur losses for this company. Now, if we move on here, we can look at 2019 nights and experiences booked by region. We can also look at gross booking value and revenue by region. So North America is the greatest, but actually EMEA was significant for nights and experiences booked by region. Asia Pacific taking up just a little less than a third there. And in terms of revenue, it's significantly less than a third. And then Latin America also is a small chunk of that. So they still have a lot more areas to grow and expand for revenue, gross booking value, and nights and experiences. North America might be somewhat saturated, but Asia Pacific can continue to grow. It's a huge region, and Latin America can definitely continue to grow as well, which is a great sign. So here's a little summary of this company. So it's going to be an extremely hyped up IPO, and it may be overvalued. Remember, the company's suffering right now. Yes, they have, nearly $5 billion in cash reserves. That's great, or cash and securities. So that's great. The revenue was growing previously. The company was really skyrocketing previously, and they have been profitable in the past, which is a great sign. However, they need to sustain that profitability going into the future. If they can survive through the pandemic, and if they can, not have to lay off too many workers, not make too many drastic cost cuts, then they can revamp their marketing budget. They can start spending tons of marketing money, get people traveling again. And once people feel more comfortable to get out of the house and go places, which I think people will be very eager to get out of the house and just go somewhere. They want to do something, been stuck in the same area for, almost a year now in some places. I think it's definitely going to help Airbnb there. And with all the hotel closures happening, that's also going to help Airbnb with less competition for them. So they're going to be able to take more of that massive, multi-trillion-dollar market that they're currently operating in. Now, IPOing during a downturn for the company, as I said, this is kind of a red flag. It may seem that they're a little desperate for cash to help them survive, but this is also a strategic position for them to help them withstand the pandemic and to get through it. So from a company standpoint, it makes complete sense to me, but it is just a little bit worrying that they're IPOing during their worst instead of their best. This could mean a big opportunity or a big risk, as I kind of touched on. Could be a big opportunity with less competition, post-pandemic, people wanting to get out of the house, get out and go travel, and they were growing. Or it could be a big risk because this could mean that, they really need cash, they're suffering, and maybe this means that they might not make it. But I have a feeling Airbnb will definitely make it through. Pre-pandemic revenue is growing quickly, which is a good sign. As I already touched on, pandemic may actually help Airbnb. Hear me out, you already did. If they can survive the pandemic, Airbnb will thrive, as I touched on. Valuation is currently around $30 billion, so definitely, it's a significantly large company, and I think that's about right for this company. It'll probably be more valued around $50 billion, though, during its IPO, just knowing how many retail investors are going to dump their money into Airbnb. It'll be super interesting. Whether I'm going to personally invest in this company on its IPO day, I'm not sure. I might wait a little bit, kind of just feel it out. But I definitely like Airbnb as a company. I love its business model. Its leadership has made some great changes to the company in terms of cost cutting. Cutting the sales and marketing budget down in order to reduce its cost and expenses was a great strategic idea. that has definitely worked out for them to not have their costs be absurdly high right now. And Airbnb has turned a profit before. So it's not like there's unicorn companies out there, who've never, or those tech companies out there that have never ever produced a profit, like Uber. I can name of quite a few there. Airbnb has definitely turned a profit, although not on a yearly scale, but on a quarterly scale. There's been about 3 different quarters where it has produced a profit, which is a good sign for this company. And it wasn't a crazy profit, but at least it's something that proves they can do it. Anyways, thanks for watching. Please subscribe. Check out these videos as well as follow me on Twitter at StockerFinance. I've been tweeting a lot lately, a lot of interesting stuff going on in the markets, so definitely check that out. I'll see you guys in the next video. Peace out.